Okay, good morning again. Welcome. This is our last week of class. I'm sure you can believe it, and I'm sure you can feel it based on uh, probably all the deadlines and the busyness and possibly even the exhaustion that comes with that. So it's the 6th today, as you know. We see each other today, and then I'll see you again on Wednesday. As previously discussed, on the last day, Wednesday, I'll review with you what's going to be on the final. We can look at some, examples of questions and things just so that people are feeling, I guess, okay about what to expect. Remember, the final is only going to be 12 and 13, and whatever we can get through on 14. At times I, took off some time to just speak about the portfolio or speak about the term paper and so on. So we will probably finish most of 14 because it's really just bonds payable, installment notes, and some bond repayment. And I'll go through that today. But if I didn't cover something in the class, I'll alert you to that as we review and make sure that people are not wasting their time studying things that are not going to be on the exam. On that same day, the 8th, is when the chapter 14 homework is due. It's been on line since I think sometime last week. So, just bear that in mind, that, that also helps you with practicing for for the exam. And then again, people know this, but if your last day to withdraw from any class with a W grade is also Wednesday, December the 8th. If you're concerned about term papers, I'm frantically trying to mark them. I'm actually looking at them here on my desk. I'm through about 10 of them, and I need to finish the rest. It takes a bit longer because we're not in person, and I can't, when I'm returning the paper, I can't speak to you about the paper and the points. So I literally am typing up a grading sheet for every person and for every section, explaining what was done well or what was missing or whatever, so that I'm not just returning a grade to you, but you can see where it's coming from. So what you can expect is, as I'm finishing the stuff, I'm gonna finish marking everything that I have, and then I would be sending everyone an email with your grading sheet and your overall grade, and you would be able to read through my comments and ask me any questions and so on. My hope is to finish that by December the 8th as well. I'm trying to march through that as quickly as possible. It just does take time, and of course, just like you have other classes also that need some attention sometimes. So the final will open on Thursday, so it's like this Thursday. We're finally here at the end. Whether it's a bitter end, I don't know. It opens on Thursday and it closes on Monday. If the Monday close is a problem for anybody, or if you guys need more time, I'm happy to close it on Tuesday. I can't even remember, because I set this schedule at the beginning of the semester. I can't remember, all my thinking around this, but there's no problem. Like if people have like a million other exams and stuff on Monday or something, I can close this on Tuesday at 6 o'clock, if that will save anybody, any type of stress. Just let me know in the chat if you would prefer the exam to close on Tuesday, and I will gladly do it. If one or two people want that, I'll just do it for everybody. Okay. And of course, you can, if you're ready to take the exam on Thursday and you just want to be done with it on Friday or over the weekend, go for it, and then you're done. I normally take like 2-3 days to do the grade, so I'll probably be done with grading by the 17th. So everybody should know what's happening with their grades by the 17th. Again, if you know already that you have many exams on Monday or something, and you just feel like you need extra time, you're welcome to tell me in the chat that I should close the exam on Tuesday. Otherwise, I'll just leave it till Monday. Just another point here about Thursday. We discussed this last week, but I want to make sure that you remember that anything that is outstanding on your e-portfolio that you haven't completed based on the syllabus. Remember this, the syllabus for, excuse me, the studio hours here, and I went through this with you guys multiple times about what is expected. So anything that is not done yet, you have until Thursday midnight to complete that. I'll be looking at that on Friday. Anything that's not there by Friday, I'm assuming has not been done. So please make sure that you publish all your sections. And if I were in your position, I would download this syllabus and have it next to me and check off next to each item that I've actually done everything that I was supposed to do, if if you feel like you're behind or something. So Thursday, December the 9th is when I am going to be going through this again. You have one more opportunity on Wednesday at 1 o'clock in the class to close up any gaps, or if you don't know how to do something in e-portfolio, to try and fix that. You may also recall last time we met, we had David in the class showing us how to upload the term paper into ePortfolio. I still have some folks over here who haven't uploaded yet. You know who you are. That has to happen that's part of the ePortfolio work also. So if you're ready to upload and you don't remember how, or whatever the case may be, just talk to me during the break. But I will be following up with you if you haven't uploaded your paper into the assessment area. Okay, so there's some deadlines coming up. There's some activity happening this week. It's a busy week, I'm sure, for everybody. Does anybody have questions about anything, any of these dates and things that I've just shared?
Hi, Professor.
Hi, Antonia.
I just need to know that how to upload term paper on ePortfolio.
Okay. So what I'll do is, I think there's actually a video and a physical document available that I know of. So I'm going to see, let me make a note here. This afternoon, after we're done, I'll send it out in an email, right? You do get my emails, right, Antora?
Yeah.
Yeah, okay. I mean, I assume, but I just want to make sure that if I send out an email, so I'm going to send out an email with assessment steps. Antora, just also so you know, the end of the last week's lecture, it's on YouTube. This might be an easier way for you to do it, I don't know, but at the end of last Wednesday's lecture, from about 12:15 or 12:20, so it would have been about 30 minutes before the lecture ended. So an hour and 30 minutes into the lecture, someone came from ePortfolio and showed the whole class to do it. So if you want to watch that video, you can do that as well. Okay.
Oh, thank you. Sure, I will watch this one.
Yeah, so maybe that's easy, but I'll send this this note out anyway with the video for how to do it, in case people that can't get to watch the whole lecture thing. Either way, you should be able to do it. All right. Any other questions about any of this?
Hi, Professor.
Hey, hi.
Yeah, the final exam is the same as a previous two tests. The 3 attempts, and then
all the same, and check your work and the time, and I'll make sure that it's not too long, and you'll have some multiple choice, same format, nothing's changed.
I see. Thank you.
All right, good. Thank you for asking that. What else? Anybody? And Marina, just so you know, by the by Wednesday, I'll give you guys a prep sheet so that you have some idea of what's going to be the exercises on the final, because there's a lot of material in these 3 chapters. So I want to make sure that people are focusing on the right stuff, okay? So I'll let you know where to focus your attention. All right, so I guess at this point, if people do still have questions about anything, you can ask me during the break. I don't want to spend any more time on admin if it's not necessary. I guess the last thing that I'll just say, as usual, if you still need classes, if you are not transferring out at the end of the semester, please register as soon as you can, especially if it's fall 2. Enrollment is kind of low, and I want to make sure that people are getting the classes that they need. So don't wait till the last minute. And if you are for some reason coming to an in-person or a hybrid class in the fall 2, sorry, please check your schedule. I said this at the beginning of our time together, September, October, whatever, November. Please look in CUNY first and make sure you know what format your class is, because if your class is in-person or hybrid for fall 2, sorry, 1 second. If it's in-person or hybrid for fall 2, you have to have your vaccination documents uploaded by December 11th. I repeat, if your class is in-person or hybrid for fall 2, you have to have your vaccination documentation uploaded by December 11th. If you are not vaccinated and you want to be vaccinated to attend the class, you have to get the Johnson & Johnson single shot vaccine by December 10th in order to qualify to get onto campus to take the in-person or hybrid class. I know how catastrophic this can be for people who are trying to transfer, not having their papers, in order. And I think it's easy to, forget that people are back on campus because we've been online for so long. So you just want to make sure that you are okay in that respect for fall 2. And then for in March for spring 1, you have to have completed the upload of all your documentation by February the 23rd in order to attend in-person classes on campus in the spring. So if this doesn't apply to you, but you have friends or people who are not as up to date with all the requirements, please tell them, because the worst possible thing is people being turned away, and it's going to happen, that people will not be able to attend classes if they're not vaccinated. All right, so keep that in mind. If you have questions about it, please speak to me. Right, so on that note, let's go back into chapter 14. This is the same documents that are on on Blackboard, right? So, right, if you haven't downloaded things yet, you can and follow along with me, or just follow along. But in any event, the information is there for you. We were looking at bonds payable when we were together last week, Wednesday, and we said that, the bonds payable is kind of the other side of the investment in debt that we were doing in chapter 12, right? So this is the company borrowing money from, various investors, breaking up that big chunk of money that they need to borrow into smaller parts, and, having this bond payable that is going to be due, in some number of years usually, and so chapter 14 is the long-term side of debt, as opposed to chapter 13 that was the current debt, current liabilities and contingencies. So we discussed, how a bond is priced, and we even did one example, which I'll just briefly go over again. We discussed that bonds are priced based on interest rates that are prevailing at the time that the bond is issued. And so the stated rate of the bond is the actual interest that the bond pays, and the market rate is, as the name implies, the interest that the market is paying or demanding, right, on a bond of that nature. And so with that amount, those terms and so on. So if the stated rate on the bond is the same as the market rate, the bond is issued at the full price, right, at face value. If the stated rate is greater than the market rate, so this bond is paying more than what the market is actually paying, a lot of people will want to buy the bond, and so it's issued at a premium. It's above face value. The price is higher than what people will be paid back. at the end. So I said, example, the stated rate is 8%, but the market rate is only 7%. The bond will be issued for more than face value. And then if the stated rate is less than the market rate, so the bond is not paying at the same levels as the market, then the bond is issued at a discount, right? So yeah, the example is if the stated rate is 5%, but the market is demanding 6%, the bond issuer will have to discount the bond in order to attract investors, right? They'll have to say, okay, I want to raise 80 million, but I'll accept 70 million because I'm not willing to pay interest of 6%, you know, at every interest period. And remember that in general for these examples we're doing, and I think in a lot in practice also, these bonds are semi-annual interest payments, so every 6 months. And so last time we calculated the present value of the bond, which is the same as saying the price of the bond, right? At what price will this bond be issued? So the present value of the bond is all the cash flows on the bond, and you use the market rate to present value. Another way of saying present value is to discount all the cash flows to the present day. So the way we did it, and I'll show you in a minute, but just for the sake of theory, we present value all the interest payments, and then we had used the annuity table, right, present value table to do that, and then you present value the actual principal payment that will be made at the end. All right, and so I'll just go over that quickly, and then after that we'll go into calculating interest on these bonds. And again, this is some stuff that you've seen before because we did amortization tables before in chapter 12 as well. The only difference was that you were looking from the perspective of the investor, and here you look from the perspective of the borrower. So if we go to exercise 1, and again, we've done this before, but I know what it's like, the time between Wednesday and Monday. So this question was basically asking you just to price the bond, right? To say at what amount would this bond sell? If a company is issuing 5% 20-year bonds with a face amount, so the principal amount is 80 million, the market yield, meaning the market rate for bonds of a similar risk and maturity is 6%. So if you were listening to what I was just saying, you can see already the company is offering 5%, but the market is requiring 6%. So in your mind, you should be saying that bond was issued at a discount, right? Because the company is not giving enough interest compared to what the market wants. So they're going to have to discount the bond in order for this transaction to even happen, because people are not going to just pay 80 million for something that's paying 5% if they can pay 80 million for something that's paying 6%. So interest is paid semi-annually, so that tells us how to calculate the interest and at what price did the bond sell. So when we revisit this example, what did we do? We asked how much is the semi-annual interest payment. And this, again, a reminder is that the 5% is what you base the interest on, because the interest is the stated rate. It's a contractual agreement that the company will pay 5% on 80 million, the face value. But remember, it's semi-annual, so it's only every 6 months. So we figured out that the interest payment was $2 million every 6 months. And so that's what we used as the interest payment. And then we had to find a present value factor, right, for calculating the present value of all these interest payments. Because basically what you're saying is it's a 20-year bond and it's paying interest twice a year. So it's basically 40 payments of interest over that time, and the market rate is 6%. Remember, we present value at the market rate, not at the bond's rate. So for the interest, we had to use the present value of an annuity. And I told you that an annuity, that word means that they are paying periodic payments happening all the time. So an annuity is different from just a lump sum payment, a big principal payment. The principal payment means there's just one big amount being paid at the end. And annuity means there are smaller amounts being paid, during the life of the bond. And that's what the interest is. So interest represents an annuity. And so we take this, and it's table 4. So when you look at these tables here, right, I was using, hopefully I'll be able to open this. I was using the present value of an ordinary annuity table, right? And I told you guys that you could download it or you can see it in the, it's right near the end of the textbook. And we're looking for 40, N is the number of periods that you are receiving the payment for. So we're looking for 40 payments, right? Because it's 20 years, 2 payments per year, and it's a 6% discount rate or the present value, right? So you go across 40 years, right? I'm just trying to follow this thing, and oh, let me just rotate it because I feel like I'm going nuts here. Okay. So I'm sorry. I'm saying 6%, but I'm making a mistake and no one's stopping me, either because you're so busy reading or you're not with me. Semi-annual payments, that's 3%, right? So it's a 6% annual market rate, right? But 3% semi-annual. My apologies. So use the market rate, not the stated rate, unless they are the same. And you're also using use half of the rate for semi-annual interest, right? That's why we use 3%, because I was looking at the paper and I'm like, this doesn't look right. Like, what am I missing? So we have to do 3% for 40 periods. So 23.11477 is the present value factor that we use. So 2 million times that amount, that's what all those interest payments are worth today. Have you, I'm sure you've seen, like, or maybe you've even won the lottery. I don't know. I mean, who knows? Like, we don't all know each other's stories, but you've seen when people win the lottery, they'll offer them, you can either get the yearly payments for however many years, let's say 40 years, or you can get a lump sum today, right? Those are normally the options. And so what do you think people go for? Anybody? Or what would you go for if you won the lottery today?
Sorry, what was the question again?
The question was, when you win the lottery, Mdadol, they usually offer you, either you can take a lump sum today, or you can take annual payments. Let's say for the next 40 years, you can take annual payments. So I was saying, what would you take?
I think I'll go with the first option.
A lump sum, right? Yeah, most people go with a lump sum. But like, let's say you win 100 million in the lottery. I'm not talking about taxes now, which is its own thing, but what you end up getting is not going to be, let's ignore taxes and pretend taxes don't exist, which would be great. Obviously, that's not the case, but let's just pretend. What you get is not the 100 million when you take the lump sum. They will present value, right, what the payments would have been over time, and you get some other amount that's lower than 100 million because you're taking everything today. But, you know, if you think from an investment perspective, it's probably best to take all the money now and invest it in the way in which you want to invest it, as opposed to, you know, dealing with inflation and stuff when you're getting payments every year. But that's all to say that if this, you know, let's say this was a person taking lottery payments, they could take 2 million every 6 months for 20 years, or they could choose to take 46 million today. That's really what this means, right? So, but for our purposes, this just means that this is part of the price of the bond payable, because the interest is, you know, part of the cash flows that the bond is giving. So 46 million of the price of the bond is interest, and then the principal value, or face value, excuse me, is 80 million based on the question. And you have to use this table here, the present value of $1, right? And let me, can I rotate this without these things showing up all the time? Okay, so, so again, it's 3%, right? Because it's the half year, you're doing the same amount of periods and the same interest rate as the interest payments. They can't be discounted at different rates. Okay, all the cash flows have to be discounted at the same interest rate and the same number of periods. So we also use 3%, and we look at 3% for 40 periods. So it's 0.30656. So that's what you multiply your 80 million by. And so interestingly, right, the big lump sum of 80 million is actually only translating to 24 million today. And so together, those two numbers give you a bond price of 70, let's say 70.7 million. So it's interesting, right? We said because the bond has a stated rate of 5%, that is lower than what the market demands, which is 6%. The bond, we already know just by looking at the question that the bond is going to be issued at a discount. And now we can see that the bond is in fact issued at a discount because the price is 70.7 million. Right now, this part that I'm going to do now is not required in the question, but I just want to show you what the journal entry will be for the issuance of the bond. And we will do other examples in a minute here where we are required by the question, sorry, to do the journal entry. So the issuance of the bond payable journal entry, right? That's what I'm going to try and do here. So remember, this is the company borrowing money and creating a long-term liability for themselves. So they are receiving cash, right? So cash is going to be the same 70.7 million that they that they're getting from investors. They're only getting 70 million. However, what they know is that in their bonds payable account, they will have to record 80 million because at the end of the term of this bond in 20 years time, even though they only received 70.7 million, they will have to pay back 80 million. And so there's obviously, the dollar amounts of debits and credits have to equal. So there's a problem here, right? There's 9.245, etc. million unaccounted for. Does anybody know what we'll call this? Wild guesses are welcome. What account is this going to be? No takers, question too hard. So this is the discount on bonds payable account, right? When we were doing this is, where things can get tricky. When we were doing the investment work in chapter 12, you also had a discount account, but it was the opposite side, right? You were looking at things from the investor's perspective. Here you are looking from the borrower's perspective, right? We are the borrower. So the entire liability is 80 million. And they will have a discount on bonds payable, which is a contra liability account. Okay, so it's a liability with a debit balance for the borrower. They'll have that account, and this account we'll see now when we do the next example. This account will end up getting smaller and smaller as time goes by through the process of amortization until it's zero at the time of maturity. Questions, anybody? I hope it's helped for those who are still following along. I hope it's helped to for you to be able to refresh, right, what we were doing last week. And if you're lost, if you're a little bit lost, I'm going to do another one now. I'm going to do number 3. I'm going to skip over number 2, and I'm going to skip over number 2 because after I put this question in, at the time I thought it was a good idea because the stated rate and the market rate are the same. So when you do the calculation of the present value of the bond, you basically come out to face value because it has to be, because they're equal. But right now, given the time that we have, that's not really, we're not proving much to do that. So I'm going to skip over number 2. The answer is in the obviously in the solutions. So when I put them up, I don't think I've put them up yet, have I? Oh, I have, sorry, I put them up last week. So the answer is there. So, if you want to practice, you can practice, but I'm going to move on to number 3. The Bradford company issued 10% bonds. So that's the stated rate, right, of the bonds dated January the 1st with a face amount of 80 million. We know what that means, right? That's the amount that will be paid back at maturity on January the 1st, 2018. The bonds mature on December the 31st, 2027, so 10-year term, right? For bonds of similar risk and maturity, the market yield, so that's the market rate, is 12%. So we see that the market rate is 12%. So already we know that this bond is probably going to be issued at a discount, right? Interest is paid semi-annually. So there's 2 periods, right? 2 interest periods in each year on June the 30th and December the 31st. I'm not sure what happened here, probably some formatting issue, but I can't read that all lumped together. Required, determine the price of the bonds at January the 1st, 2018, prepare the journal entry to record their issuance by the Bradford company on the same date, prepare the journal entry to record interest, the first interest on June the 30th at the effective rate, and prepare the journal entry to record interest at December the 31st. So calculate the price of the bond, record the issuance of the bond, record 2 interest payments, right? And so let me just go back up here for a second and talk about interest. You've seen this already, even though you may not remember that we use the effective interest method to calculate the interest, in this case, interest expense on the bond. And it basically means that you use the market rate of interest multiplied by the outstanding balance of the debt. Now, saying this in words sounds a little bit maybe involved, but when we do an amortization table, you'll see what I mean. All right. So the actual interest cash that is paid is the stated rate times the face amount of the bond. That's the cash that by contract people have to receive. But interest expense is based on the carrying amount of the bond and the market interest. Okay, and any difference between those 2 numbers is going to be an amortization of the bond, the discount on bonds payable or the premium on bonds payable, right? And yes, we know that if there's interest that's accrued, we have to make an adjusting entry. So we'll be using the effective interest method for this question right now. There's also another option called the straight line method, which I'll show you in the question that will follow. In number 4, I'll show you the straight line. It's much easier than the effective method, but effective interest method is what is used generally. All right, so we're going to go into doing number 3. If you haven't downloaded the question or whatever, please either download or take a picture. I'm going to go between the answer sheet and the question sheet, right? Okay, so exercise 3. So the first thing that we're doing is calculating, right? This was number 1. What is the price of the bonds, right? That's the question there. And so we follow the same approach as here, right? We're going to do the amount, the present value factor, and present value. And I'll give you a chance to catch up to me. I know Gian is going to tell me to slow down. Okay, so set yourself up however you want to do it, but I'm setting it up like that. What's the amount of interest? What's the amount of the principal? We're going to find present value factors based on interest rates and the term of the bond. Okay, so we have to remember that the term of this debt is 10 years, but it pays interest twice a year. So N for our purposes is going to be 20 because it's 10 times 2, right? 10 years twice a year. Also, it's paying, or the market is yielding 12% per year, but since we're using semi-annual interest, we are going to use 6%. So I'll write that out over here. For the interest, it's the present value of an ordinary annuity of $1. N equals 20, so it's 10 times 2. And I, the interest, equals 6%, it's 12%. Sorry, 12% divided by 2, right? That's how we'll find the present value factor for interest. And the present value factor for the principal is not an ordinary annuity, it's the present value of $1 because you're not paying every 6 months, right? The principal. I'm using, sorry, this is supposed to be $1. Yeah. I'm using these asterisks to convey what the present value factor is going to be for that particular item. I'll give you a minute here to catch up. Or to ask me any questions before I go into the calculations. Oops, sorry. So the interest, right, the interest amount we need to figure out here. So it is an 80 million bond times 10% interest times 6/12, right? So it's basically 4 million, obviously. It's half of 8 million. So the semi-annual interest will be 4 million. And now we have to go to the table and look for the present value factor. We're looking for 20 time periods, N is 20, and interest is 6%. So again, for the interest, you have to be using present value of an ordinary annuity, 20 periods, and 6% there, 11.46992, recurring or whatever, right? And it was like 11.4692. So you don't have to calculate, using the formula, but if anyone's wondering where does this number come from, it's basically the present value formula calculation results in this number that you can then just apply. You could also go the long way around and use this formula. For those people who maybe end up going to study finance, and that was my other major besides accounting. We used to have to use this long formula to calculate it, but it gets you to the same place, all right? So 11.46992. So you multiply, right, the 4 million by that. That's going to give you this number. Let me just fix it. 45,879,680. So that's how much the interest payments over the 10 years, that's how much it's worth today. And notice how you can't just say, 4 million times 20 payments, right? So that's 80 million. So that must be the interest because of the time value of money, right? $1 today is different from $1 in 10 years time. So we have to take that into consideration. So now we've got the 80 million principal, right, that we're going to figure out. The present value of $1, not of an ordinary annuity, but of $1, also 20 periods and 6%. So here you see present value of $1, 20 periods, and I'm going to go across to 6%. So 0.31180, right? 0.31180. So we multiply, oops, I should have just kept whatever the thing was trying to do here. So 24 point something million, 24.9 million. So that's the present value of the bond. You just add those two numbers together. So again, that was the requirement for item number 1, determine the price of the bonds. Questions, anybody? It's basically almost identical to what we did in the first example. Okay. So if I don't have questions, I'm going to do the second piece, which was asking for the journal entry, right? Prepare the journal entry for the issuance of the bonds. So we've already had some practice with this in the example above, issuance of bonds payable. Right, so let's see if I'm giving myself enough space here. So again, the cash is the same amount that you just came up with over here, right? That's what the company is actually receiving. So that's what you put in as cash. Remember, they had to make the bond price less so that people would actually invest because the interest on the bond is less than what they can get in the market. Bonds payable will always and forever be at face value, right? There's no changing that. And the difference here, again, the difference between these two numbers, a debit balance 9.1, that is called discount on bonds payable. So that's the issuance of the bond journal entry. I'll leave it there to simmer and you tell me any questions you have. All right, so I'm not hearing anybody complaining or asking questions. So the next thing is the journal entry for June 30th interest. So yeah, I'm gonna have to leave some space because I actually have to build an amortization table with you in order to get the June and December interest going. So I'll also just leave space for the journal entry for December 31 interest. And it's all, 20, let's be clear here, because I don't want you to think I'm doing a different year. It's all the first year, 2018. So we'll skip it, like leave it blank until we do the amortization table, because the amortization table will help us to see how much interest expense we need to recognize and how much of the discount on bonds payable is being amortized. So here goes the amortization table. And again, this should look somewhat familiar because we did it in chapter 12. We just did it for the investor, not for the borrower. So you have a column called cash paid. In fact, sorry, let me put the date. Then you have cash paid, right? Then you've got interest expense, and that's going to be the 6%, right, that you're gonna use. Then you're gonna have this column called discount amortization. Then you're going to, you can call it principal, or let's call it carrying that, or amortized cost, probably. Any of these terms are fine. If you want to call it carrying value, that's also fine. I don't know why I'm overthinking that. You can really do any of those. Okay, so this is the beginning of an amortization table. I'll give you a minute to throw stuff up if you want to do your own amortization. And we're not going to go crazy. We don't have to do the whole amortization table. Yeah, we're just trying to do the first 2 lines of interest so that we can do our journal entries. Okay, so when you are, if you're practicing on the homework or whatever, see how much they're asking you for, like how many entries they're asking you for, because you don't want to waste time building a whole table for nothing. Well, not nothing, but I mean for 2 things that you need, and the rest is just wasted time. Okay, so January the 1st, 2018, that's when, you know, we start. So over here, what we do is we take the beginning, right, balance. This is the amount that the bond is going to be carried at. How do I know that? Because when I do the balance sheet, okay, what I'm saying is bonds payable. That thing is horrendous today, I'm sorry. Bonds payable is 80 million. And then you put less the discount. Right, discount on bonds payable, you make the whole, you know, long name. But then this becomes the carrying value of the bond. And as time goes by, the carrying value gets higher and higher. The carrying value based on what we did in chapter 12 is also referred to as amortized cost. Okay, it's the same. Remember, bonds that are held to maturity, amortized cost, same thing. So amortized cost is this number, and so that's where we start on our amortization table. We don't start at 80 million. We have to recognize that there's a discount, right? And so now June the 30th is the first payment, right? We know that the semi-annual payments for interest, we calculated it above here. We don't have to waste time to calculate it again. We know that it's 4 million, and that cash payment stays the same. Okay, 4 million. It's always 4 million, right? And over here, if you want to, you can, you know, do something to remind yourself that the stated rate for this bond is 10%, and the yield is 12%, and that it's semi-annual, so that you know why am I using 6%, because it's 12%, right, interest based on the market yield, but I'm doing it every 6 months. So that's where the 6% comes from. Stop me at any time if you have follow-up questions. All right. I'm assuming that because we have some history with the amortization table from chapter 12 that people are not completely lost. Yeah, but maybe a bad assumption. So you take the carrying value of the bond. This is how we would normally do this, and you multiply it by the yield, right? But for 6 months. So that's going to give you some number, right? Let's see what this number is. 4,249,420, right? Or 421, depending on, you know, what McGraw-Hill says in terms of how you round. So obviously the interest expense is bigger than the actual cash paid. So what is the difference, right? The difference between these two numbers is the amount of the discount that is being amortized, being added onto the carrying value of the bond, okay? So the part of the discount being amortized gets added on to the carrying value of the bond, okay? So what we do is we say 70 plus this 249,000, and so that's the new balance on the bond. And what we've also done now is given ourselves our journal entry for June the 30th, because this is the cash that we're paying, credit. This is the debit for interest expense that we have to recognize. And then we also have to decrease the discount on bonds payable account. So we have to credit it by this amount. Okay, so I'm going to go up and do that now. So over here, you have interest expense, right, is the debit, and you take it straight from the sheet there, the amortization table. Just want to make sure that I'm putting the debit in the right place. Then you've got discount on bonds payable decreasing by the amount of the amortization. Remember, this is usually a debit balance. When we recognize that the first time it was a debit balance, now it's decreasing, right, as a on the credit side. And then you've got cash, and the cash that you pay is 4 million. And that's the journal entry for interest on the bond. Questions, somebody? All right. So then we come to December 31, same deal. Cash is still going to be the same. Over here, you take the most recent balance, right? The recent carrying amount, and you multiply it. See, Excel already wants to do, you know, it's predicting what I'm going to do. So that's correct. It's times 6%. So you've got 4,264,000. Notice how the interest is going down a little bit. Not down, sorry, what am I saying? The interest is going up a little bit because the balance has gone up. So there should be a change in this number. There's no change in this number, right? And as a result, the amortization on the discount is also going to increase because the balance is going higher and higher. And we know, remember I told you that at the end of the life of this bond, at maturity, the discount balance will be completely gone, right? It would have been completely amortized. And so all you do now again is you add the 71 and the 264. And so that's the new balance on the bonds payable. But what you care about is what they asked you to do, which is the journal entry for December. So it's interest expense. And you can pull it right off from there, right? Discount. What is happening with my fingers? Discount on bonds payable. Nope, that 264. And then the cash that is paid is the same, 4 million. So you only needed to do 2 lines of the amortization table. If they if they'd asked you for only one interest payment, then you would just do the first line, right? I think the critical part of the amortization table is to know which amount to start with. So you're starting with whatever cash you actually received, you know, as the price of the bond. That's the carrying amount of the bond. I'll give us maybe a minute here for people to catch up or to think of questions that they have about any of this. All right. So that's the bond payable with effective interest rate method, right? When we come back from the break, I'll show you how the straight line interest works, and then we'll also do an installment note. I think a lot of us are familiar with installment notes because of car notes and things like that. So we'll also do installment notes. And then I think the last thing that we'll probably be able to do is a bond redemption, right? What happens when we redeem a bond before maturity. So come back at 11:42 and we'll carry on with this material. start back up again, back from break. I just want to go into the notes a little bit to talk about straight line interest, and then we'll do a small example. It's a very simplistic method of calculating interest when there's a discount or premium on the bond. The book is pretty focused, it's seemingly on discounts, so a lot of the examples have discounts. So the straight line interest method, a company is allowed to determine interest indirectly by allocating a discount or premium equally to each period over the term to maturity, if doing so produces results that are not materially different from the usual and preferable interest method. And when they're saying the preferable interest method, it's the effective interest method that we just used when we were building that amortization table. But this, I guess what GAP is saying is, if you have a discount or premium on a bond and you could just recognize it equally over the term of the bond, and the answer that you get isn't very different from what you would get if you did an amortization table, you're allowed to use the straight line interest method. Allocating the discount or premium equally over the life of the bonds by the straight line method results in a constant dollar amount of interest. So unlike what we just saw with the amortization table, where the interest expense is different every period, when we do this method, because we're just basically chopping the discount or the premium up into small pieces and using the same amount for every interest payment, you end up with the same amount of interest expense every period, and you don't have to prepare an amortization schedule. Now, let me just say that the effective interest method is way more used and way more popular. So I'm not going to, suddenly say that we only need to use straight line interest. I will show it to you, but it's a lesser, method, because you almost have to do both methods to see if straight line would be very different and then decide which one to use. So most of the time, the companies and the banks and stuff will just use the effective interest method. But we'll see this one anyway, so you can understand what it's about. So this is number 4 for straight line, okay? On January the 1st, the company issued 3%. So that's the stated rate, the actual interest rate, right? 20-year bonds, there's the term of the bonds, with a face amount of 80 million, right? Principal balance for 69,033,776 to yield 4%. So it's at a discount. Here we go again. Interest is paid semi-annually. So it's going to be 40 times, right? Over the life of the bond, interest will be paid 40 times. What was the straight line interest expense on December the 31st annual income statement? So they're asking how much interest expense dollar amount should the company recognize. Now remember, if it's semi-annual interest and this bond was issued on January the 1st, by December the 31st, there would have been 2 installments, right, of interest that you are recognizing. I shouldn't say installments, but 2 interest payments that you're recognizing. So let's go ahead and see how we do the straight line method. And apologies if I'm making a noise. I'm sucking a lozenge because something's irritating my throat. I'm sure you don't need to know that, but just there might be some weird noises coming from me. All right. So again, this is the straight line method for interest, right? Let's call it discount and premium amortization. And so it impacts interest expense. I didn't mean for that to get so long, but saying there's a straight line method for interest, it's true, but it's a little bit more than that. It's a straight line method for the amortization that then impacts interest expense. So you have the face amount of the bond. I'm just showing you how we will calculate the discount if you don't want to do journal entries. So the face amount of the bond is the 80 million, right? The cash was 690,33776, right? So the discount, they didn't ask us for journal entries. So I'm not wasting time with journal entries. The discount is this amount, 10,966,224. And it's this amount, right? This is what we will amortize or recognize, let's put it that way, over 40 periods. So the discount to be recognized each period equals this divided by 40. And why 40? Why 40 periods? Because it's 20 years times 2, right, semi-annual. This was the discount divided by 40. So each interest period, you will recognize $274,156 of the discount. Notice before, this is not the same question because the interest rates and things are different, but I'm just trying to show you when you do the effective interest rate method, the amount of the discount that you recognize changes every period, okay? Because your interest expense amount is based on, right, the carrying amount of the bond. When you do the straight line method, you decide basically at the beginning to just recognize this entire 10, almost 11 million in equal parts over 40 periods. So you don't have to be concerned with an amortization table. And so if you think about, you know, what did they ask us in the question, right? They asked, what is the interest expense, straight line interest expense at December 31st, right? That's what we need to know. This is not the interest expense. This is just the discount amortization. This is the same as if you went back to, you know, the question that we just did above, where I put this credit over here. That's the same as this number, right? We're looking for how much is the interest expense. So if it's easier for us, we could just make a journal entry to say, let's say interest expense journal entry each period, because it will always be the same because you're doing straight line. Let me bring this down. So we don't know what the interest expense is each period. We do know that the discount on bonds payable is going to be a credit of this amount that we just calculated. Right? And we do know that there's going to be cash paid. We have to go back to the question to see how much. It's a 3% bond. So every 6 months, you're paying 1.5%, right? So the cash is going to be based on the 80 million times 3% times 6 months out of 12 months, which should come out to 1.2 million if you do the math. So that's 1,200,000. That's contractual, right? It's the same amount every time, just like this was the same amount every time. And so what we're really looking for is this interest expense amount. So based on what we're seeing for the discount, that will be the same on under straight line, always the same. The cash is the same, so the interest expense will also be the same. So if you think about the fact that this is a semi-annual bond, June 30th interest expense, right, is this amount. Your December 31 interest expense is the same amount, because the interest is always the same every period. So to answer the question that they're asking, how much is interest at the end of the year? Total interest, right? Expense for the year is 2,948,311 or 12, depending on the rounding. Should really be 312 because there's 6 and 6 here, but I guess because I didn't round everything, 312 cents. I mean, no, yeah, not cents, $312. I'm gonna let that simmer for people to take notes, but for people to also think about potential questions they have for me. Okay, so no one has anything to add. I'll just repeat, this is the straight line method for the interest expense calculation, but specifically the straight line method is being used for recognizing a discount or premium on bonds payable. And when you do that, you basically ask how many periods will there be interest for. In this case, it's 20 years, but it's semi-annual, so 40 periods. You divide the discount amount by that number of periods to end up with the amount of the discount that you will recognize every period. Your cash amount stays the same because that's contractual. So your interest expense is basically a plug, as we would say, right? A plug number you solve for the interest amount. And it's going to be the same every period for the 40 periods. So when this question was asking how much is the straight line interest expense at December 31st, it's just asking for 2 installments, right? Because you would have had June and then December. And this is very different from what we just did, which was before, which was the effective interest rate, where the discount amortization will be a different amount every period. And what does GAAP say? It says you can use the straight line method if you have determined that using the straight line method doesn't result in a materially different journal entry or outcome than the effective interest method. So that's a little bit tricky because it then just means that you have to calculate both, right? And see whether there's a difference or not. So, sorry, most of the time we're using effective interest method. Okay, it's almost like with, I don't know if you guys remember with statement of cash flows, GAAP allows you to use the direct method, but then in the footnotes, you have to show the operating activities under the indirect method. So then it's like, then why would you use the direct method if, operating activities, which is the hardest part of the indirect method, cash flow has to be shown anyway. So a lot of companies just use the indirect method for their cash flows. It's kind of the same thinking, right? So let's move on. If there are no more questions or any questions for me. The next topic that there's not a lot of topics here, right? So the next topic that we'll cover is installment notes. And there's some bit of information about that. It's not, there's not a lot of theory around that, because you'll see that it's what we already know. You know, if you've ever bought a car with a car note, I mean, I know we're in New York, so it's like we don't necessarily have cars, but or you've bought something where you have to pay installments, maybe even a phone or something like that, or you're doing some type of you know, this new thing where when you buy anything online, it offers you to pay via some of these payment methods where you can pay in installments, right? You can pay off your dress or Christmas presents, or sorry, holiday presents, or whatever you're celebrating by installments. So what that means is, unlike with this is the key issue, right? Unlike with a bonds payable, where you still pay the principal amount back at the end, right? Remember, when you pay off a bond, you still have to pay the face value, 80 million, whatever we saw on these examples. With an installment note, you pay off your installments and then you're done, right? There's no big balloon payment at the end. A house mortgage is, you know, almost like that, where once unless you have a balloon payment on your mortgage, like, but we don't have a balloon payment on our mortgage. So basically what happened with us is they work out, this is the amount that we borrowed, this is the interest rate, this is the number of periods, they come up with an installment amount. If we keep paying that installment amount every month for 30 years, when we come to the end of the 30th year, there will be a zero balance on the mortgage. Okay, so that's the nature of an installment note, that that after all those payments are made, there should be nothing left to be paid. Bonds payable, once you've paid the interest, there's still the principal to pay back at the end. Okay, when a company borrows cash from a bank and signs a promissory note, the firm's loan liability is reported as a note payable. So mortgage payable is an example of a note payable. A car note is a note payable. Any other borrowings, you know, under note payable, same thing. Notes can be issued for cash or for assets or services. Occasionally, the stated interest rate is not indicative of the market rate at the time the note is negotiated. And if that's the case, then you just look at the asset or whatever service is being provided as the indication of what the market rate is. What they're trying to say is sometimes people try to do all kinds of funky agreements where, you know, you lend someone money at like 0.1% or something, you know, as like a favor or whatever. But first of all, the IRS will never let you get away with that. Like, they'll impute what they call impute an interest rate. They'll say, what is a reasonable interest rate? Or, you know, you have to look at the value of what you're receiving, and based on that, then they'll be able to establish a market rate. We won't go into this. We don't have to establish market rates ourselves. We'll be given that, but just know that, you know, I guess this is closing the loophole for any type of abuse of the system, of people, you know, borrowing at like crazy rates. This also applies in the tax code, like family members lending money to each other at 0% interest rate or whatever. The IRS will just calculate what the interest rate should have been based on market rates. Installment notes, and this is what we're dealing with now. Car and house notes usually require monthly installments to be paid. Each installment includes interest on the outstanding debt. Again, at the effective rate, there's that effective interest method again. The remainder of each payment reduces the outstanding balance. At maturity date, the note balance will be zero because there's no lump sum, right? You don't expect that once you pay your last installment on your car or on your house, that the bank's going to come knocking on your door and say, hey, you still owe us, you know, the original amount that we lent to you. That's not how it works. So let's go and look and see how to do a question. It was as simple as that, okay, the theory. Let's try and do a question on installment notes. This one is a bit simple because all it's asking is just how to calculate the installment, which is which we would have to do here in number 2 of this question number 6 anyway. So I'm going to just shift this down again. Sorry, I seem to have messed up the formatting of this question or of this chapter at some point. But anyway, Let's look at number 6 together and see if we can figure out how to do the journal entries for an installment note based on the information that we are given. American Food Services Inc. acquired a packaging machine. So this is what they bought now, probably using a note payable from Barton and Barton Corporation. Barton and Barton completed construction of the machine on January the 1st, 2018. In payment for the $4 million machine, American Food Services issued a 4-year installment note. Right, so that's the language that they use. They're basically just saying we didn't pay them cash. We gave them what you'd say like an IOU, like I promised to pay you this amount off over 4 years, to be paid in 4 equal payments at the end of each year. So there's the installments, right? 4 equal payments. The payments include interest at the rate of 10%. So we're talking about $4 million that the note's going to be, a 10% annual interest rate with annual installment payments 4 times until basically they've extinguished the debt. All right, those are the facts of this question. So now we need to know, what do we have to do? Prepare the journal entry for the purchase of the machine. All right, prepare an amortization schedule for the 4-year term of the installment note. Prepare the journal entry for the first installment payment on December 31st and the third installment payment on December 31st, 2018 and then 2020. If you're going to build the amortization table anyway, you have all the information that you need for the installment payment. So that's not really a huge deal. It's, the fact that they skip over 1 year. The point is just that you actually have to build the table, right? Okay, so let's start. I'll maybe give you 30 seconds here for those who want to take down key features of the question, or if you want to take a picture, and then I'll start doing the question with you. Okay. Exercise 6. This is an installment note, just in case when you're looking back. Doesn't necessarily say that on the question. So the first requirement is the issuance of the note. That's the journal entry that we're looking for. So when you issue the note, there's no calculation of installments or anything like that. You're literally getting the equipment and you're creating a liability. Okay, we've seen this before when we have done just regular back in the day when you were in accounting 1 and 2, whatever, right? You purchased equipment by issuing a note payable. That's this journal entry. Debit the equipment, credit notes payable. No calculation of interest, no messing around with installments, nothing like that. That's it for the issuance of the note, item number 1. Okay. So for number 2, though, things get a little bit more interesting. You have to prepare the amortization schedule, right, with the 4 installment payments. So let's get on to that. Number 2 is the amortization table or amortization schedule, however you want to call it. It's the same thing. So when we've just done this, right? So hopefully it's not too hard to remember, right? There's the date. There's the cash that you're going to pay, right? There's the interest expense. In this case, there's no discount or premium amortization. What you will call this is just reduction in principal. And then you will call this the outstanding balance. So typical setup of an amortization table. So the first thing we'll do is remember that we borrowed this money on January the 1st. I should have put that over here, sorry. So for the first date, it's January the 1st, 2018. We're going to have our $4 million beginning balance. And the point here is that after 4 installments, this 4 million should be 0. Okay. The interest expense, remember, there's a 10% annual interest here. Sorry, so I should have put 10% here so we know what we're doing. But we have a problem because I don't see anywhere in the question where it says how much cash is paid for each installment, right? Do you agree? When we look here, there's nothing. It doesn't say with some of the other questions that told you exactly, you know, how much interest is paid or whatever. There's no discussion here of the installment. What that means is that we have to calculate the installment amount using the present value tables. All right, that's how we're going to do it. And the way we do it, and I should have left a little bit more space here. The way you're going to do it is you're going to say the amount of the loan and you're going to divide it by, right, some present value factor equals the installment. So, I mean, not to get too technical, but this is basically the reverse of what we were doing when we were calculating the present value of an ordinary annuity when we did interest calculations. Here, what we're trying to say is we know what the present value is. It's 4 million, okay? We know what N is, we know what the interest rate is, but we don't know how much the installment is. Before we knew what the installment was and we knew what the N and the interest were, but we didn't know the present value, okay? So it's basically going to be the 4 million divided by some factor, which at this point, I don't know, right? And how do we figure that out? Well, first of all, N equals 4, right? Interest or I equals 10%. This is annual, so there's no dividing by 2 or anything. And you're going to do present value of an ordinary annuity. And it's an ordinary annuity because it's multiple payments, right? It's 4 payments. It's not just one principal being paid back at the end. So we need to go to the present value of an ordinary annuity table, look for 4 periods and 10% and find what the present value factor is so that we can calculate the installment amount. So I'm going to do that now. So N is 4 and interest is 10%. So I'm looking for this 3.16987 is going to be the present value factor that I have to use to calculate the installments that over 4 years get me to a present value of 4 million. So I guess I'll just keep doing it here. So 3.16987 is the present value factor. And so that gives me an installment of this. $1,261,881. So what does that even mean? It's saying that if you are being charged 10% interest and you have to pay back 4 million over 4 years, right? You will have to pay 1,261,881 every year for 4 years to be able to pay back everything that you All right, that's what that means. And you'll see that if you had to multiply, I mean, you don't have to do this, but you have to multiply 1,261,881 by 4, you're not coming back to 4 million, obviously, because it's including interest as well. So this person is or this company is basically paying over $1 million extra, right, by using an installment sale as opposed to just paying 4 million outright. And I think we know this already because we know this from our own lives, right? If you charge something to your credit card and you don't pay it back immediately, you can start getting charged interest. So then it's, you pay the minimum amount. If you added up all the minimum amounts that you would pay for the number of years that it says at the top of your at the top of the document, your statement, that tells you how long it will take you to repay the balance if you only pay the minimum. If you had to multiply that out, you would see how much you really are ending up paying, so for the pair of shoes that and this is not a judgment call, I'm just saying, like, this is just facts, right? For the pair of shoes that we're charging today on our credit cards and paying off over, minimum amount over time, you may find that you're not even wearing the shoes anymore by the time you actually finish paying it. And if you multiply out how much you paid, you probably paid triple or quadruple the price of the shoes. Does that mean you shouldn't do it? That's not the point of this discussion. You know your own finances. I'm just saying that it's important to realize that an installment sale, especially because of the increase in the popularity of this buy now, pay later, approaches. There's a lot of companies that have been coming up. Every time you buy something online, you see, oh, pay this in so many installments or whatever. That installment, always just check how much that installment adds up to, right? If you're buying something for $100, but you're going to end up paying, 150 or 100 and whatever, if you do have the money available right now, you may be better off not buying in installments because of the extra. I mean, everyone has to make money some way, right? And that's how they make money, by charging you interest for financing. So yeah, same thing, right? There's definitely extra amounts being paid. People generally expect that. When you buy a house or a car, I mean, by the time you pay off only the minimum mortgage balance per month, you're probably paying close to, depending on the interest rate, 50% more than what you borrowed from the bank. Right? So January the 1st, we still owe 4 million. At December the 31st, 2018, I keep doing it. This is the first installment. So now we know that the installment amount is 1,261,881, right? And it's going to be the same thing for for the 4 installments. This stays the same. So December 31, I'll just have some like pick or something where I keep doing that. December 31, 2019, December 31, 2020, and then remember they asked you for a full amortization table. That's why I'm doing this. December 31, 2021. So there's the 4 installments that you're looking for. The interest is the same like what you did in the previous amortization table. It's the outstanding balance times the interest rate. So for the first go around, it's just going to be a very round number at 400,000. And so the difference between these two numbers is the amount by which the principal, meaning the outstanding balance, is going to be reduced. And reduced, right? Not increased. We were increasing the bonds payable balance earlier because we had issued it at a discount and we needed to grow the balance to get to principal. Here you're trying to pay off this whole balance. So you subtract the reduction in principal from the outstanding balance. I'll stop there so you can think about it and ask me any questions before I move on. All right. So what now? The next one, you're just gonna do this balance times the 10%. So see, because you, and this is what happens with with a mortgage as well. Because you decrease the principal by some amount, the interest expense portion gets smaller and smaller, right? So as the years go by, you're paying off more of the principal. So 948, and now you're going to subtract this 948 from the outstanding balance. So now your new balance is 2.1 million. All right. Again, take that new balance, multiply by 10%. That's your interest expense. It's decreasing, right? Getting smaller because the outstanding balance is getting smaller. Now you subtract that. So this is the new amount by which, see how big this number is getting now, right? The principal is going to be reduced by this amount. So we subtract it from the 2.1 million, leaving us with this 1147. And for the last installment, you're taking that 1147 times 10%, that's your interest amount. Subtract that from the cash that's being paid, and we're going to be off by a few dollars, but it's just an $8 rounding. It will end, it's supposed to be zero. $8 rounding is not a big deal. It would be rounded down to zero. Or the last installment will be just adjusted slightly for whatever is needed to make it go down to zero. Hopefully you see that. Everybody or anybody have a question about how to build this table? So now we actually have to answer the question, right, that we were asked. So there was for number 3, it was the December 31, 2018. I don't know what is going on with my finger. December 31, 2018 installment. And then the last one is the 2020 installment that they're asking for. Now you can literally just pick these numbers off of the table, right? That's what makes the table so useful. It's an interest expense for the company. There's cash that's paid, and there's a reduction in a liability, so that would be a debit, right? The decrease in the liability is a debit, the interest expense is a debit, and the cash is a credit. So this is how it goes. Interest expense, debit, because it's an expense, $400,000. Then you've got notes payable. That balance is being decreased by the reduction in principal amount. So you're going to do that. The liability is going down because you paid it off, or part of it off. And the cash is going to be the same as the installment amount. And then we're looking for the December 31, not 2019, but 2020. So watch out what the question is asking for. 2020 installment. Okay. So you can already, if we were less if we had a little bit extra time, I mean, the fact that I want to set aside a day for review kind of cuts into this chapter, but if we were less pushed for time, I would be having you guys do these journal entries and then give me your answers. But for now, just let's, I hope you're just following what I'm doing and you'll have an opportunity to practice for homework as well, right? I normally prefer to do an example and then give you one to practice, but I want to make sure that I give you the ability to complete all the homework. So I need to go through everything that could show up on the homework. All right. So for the December 31, 2020, just make sure I'm putting the right amount in here. We're gonna do this line, right? So interest expense is the 219. Notes payable. $1,042 and cash is the same, right? But it's just the split between interest and the principal reduction that has changed. Okay, so we've answered this whole question. I'm going to leave it up here for a minute or two for people to either copy stuff down or just think about things. And again, the floor is open for any questions. Okay, so I think that's probably enough time for anyone who was copying something down. No questions yet? It's probably the less intense work than some of the other things we've done together. So I'm hoping no questions is because the work isn't that brutal like some of the other chapters, right? Yeah, we've been through a lot together, and this stuff is maybe a little more welcome because it's not as crazy. So I just want us to look at parts. The textbook is broken up like this with this part A, B, and C. So part C has some stuff in it. The main thing here in my mind for you to be able to do is the early extinguishment of debt. There's it's very fancy way of saying the company decides to pay off their bonds payable before maturity, right? And there's what I consider to be a 3-step process that will help us to make that journal entry, because that's really what we're trying to do, is just to make the journal entry. So I'll go through the theory here, and we've got one example that we can, go through, and you'll see that the 3-step approach to the journal entry will be able to get you to basically the correct answer every time. So if a company chooses to retire means repay the debt before maturity. So if it was a 20-year bonds payable and they decide to repay it after 2 years or after 10 years or even after 19 years, anything before 20 years, because they're repaying it and it's not just at face value necessarily, because it's not at maturity, there may be a gain or loss as a result of that transaction. And the transaction itself is referred to as early extinguishment of debt. extinguish just means to put something out. So, you know, like you extinguish a light or something. So it's really just, I don't know, you know, you don't have to go with this fancy terminology. You're really just paying back the debt before you actually needed to. And sometimes companies will write this into like their bonds payable and so on, because they're saying they want the option to what is sometimes referred to as call the debt back to repay it. It can be callable, because they don't want to be stuck paying maybe a certain interest percentage for the life of that debt in case there's a change in the interest rate environment, right? So right now we're in a very low interest environment. We've been in that environment for a long time. So a company that issued debt maybe many years ago, like let's say 15 or more years ago, as the interest rates were falling over time, they may, you know, have wanted to pay back the debt that they had issued at a much higher interest rate to avoid all that extra interest expense if they can go and borrow at lower rates, right? So I hope that makes sense, that you know, just like any of us, if we, let's say you have a whole lot of credit cards and debt on various credit cards, you normally try to pay back the credit card with the highest interest rate first so that you can save on some of that interest accumulation. So kind of the same things. If a company has written into its bonds payable that it will be able to pay it back in early, then it might call that debt. So here are the steps involved in journalizing the extinguishment of the debt. Think about what's happening, right? There's a bond payable liability on the company's books. Along with that, there may be a discount on bonds payable, which is a debit balance, or there may be a premium on bonds payable, which is a credit balance. For whatever reason, I have to go back into the textbook and look. I don't understand why there's only discount examples, but maybe I overlooked something, and then on Wednesday I can probably do a premium example with you. But nevertheless, a discount on the bonds payable is a debit balance normally, and a premium is a credit balance. So what has to happen is you have to remove the carrying value of the bond from your books, all right? And in order to do that, you basically have to do the opposite of whatever the balances are on these accounts. So for instance, to remove a bonds payable, you will have to debit the accounts, right? Because it is normally, I should have written this in at the start, normally a credit balance. So to remove a credit balance from the books, you have to debit it. The premium on bonds payable, you're also debiting because it is normally a credit balance. And don't get confused with chapter 12, please. That's from the perspective of someone who's investing. We're looking at the perspective of someone, this is a typo, yeah. Oh boy. If you're looking at this, I'll put this note back up, but that was a typo. It should be credit discount on bonds payable. It's normally, see, even I got confused. That's bad, right? It can happen to any of us. So this is normally, normally a debit balance. So let's go through it again, especially since there was a typo here in the middle of the whole mix. So when you look at the journal entry to when we issue a bond, right, we're crediting bonds payable. If there's a discount, we would have debited discount on bonds payable. If there was a premium, we would have credited premium on bonds payable. When we need to remove all those accounts, we have to do the opposite of whatever the normal balance is. So bonds payable normal balance is a credit, so we will debit bonds payable. Premium on bonds payable normal balance is a credit, so we will debit the premium to get rid of it. And then finally, remember I fixed this now, discount on bonds payable is normally a debit balance. We just saw that several times in our work. So we will have to credit to remove all of these balances from the books. Okay, that's the point of the first step. You are removing the carrying value of the bond. That's the way you can think of it, right? Removing the carrying value of the bond. Then an easier step here is credit cash for the amount paid. And they're going to tell you at what amount they redeemed the bond. And sometimes it's redeemed for more or less than face value. So it can be face value. And again, I'll put this notes back up again. Can be face value, premium, or can be face value above or below face value. The amount by which the company does, the pays, it's sometimes negotiable. It's determined by what they put into their contract. The question will tell us what they did. I'm just saying that there isn't really a way to predict at what amount a bond will be redeemed before maturity. Okay, we will just have to look for that information in the question. So you credit cash. So you've debited and credited anything to do with the carrying value of the bond. You credit the cash for the amount paid, and then you have to calculate and record any gain or loss on this transaction. A gain is always a credit and a loss is a debit, okay? And the gain or the loss is calculated as a difference between the book value of the bond and the cash that is paid. I'll repeat. Any gain or loss, right, is basically you're asking yourself, how much money do I owe? That's the carrying value of the debt, right? How much money do I owe? And how much money did I actually pay, right, for paying off the debt? And it's not necessarily always the same amount. So a company may owe $200, bonds payable, but they pay $220 in order to settle it early. That extra $20 is kind of to compensate people for the fact that they're not going to get interest anymore, but that $20 extra that they pay would also represent a loss because you're paying $220 to settle debt that is only $200. That's what we mean by gain or loss. So if the cash paid is more than what the company actually owes, and what they owe is the book value of the debt, then there's a loss. And the opposite way can also happen, but there, I guess it will depend on the bond's terms. They owe $200, but they only have to pay $195, right, to settle the debt. So then they've made a $5 gain because the cash that they're paying is less than what they actually owe. And all of that information is given in the question. All right, you just have to know which part of the question information applies to which of these three steps that you are doing. Okay, so I'll give you a moment to just digest that because it's a lot. And if you have a clarifying question for me, go ahead. Otherwise, I'll spend the last 10 minutes just doing an example so you can actually see what I mean. All right, so that's the digestion minute gone. So I'll take you through an example to see how we apply the three steps. So it's number 7. Number 7 is the last thing we'll do in this chapter. Just as an aside, the last two examples are to do with convertible bonds and bonds with detachable warrants. I didn't give you homework on this because I suspected that we wouldn't get to this, and it's kind of minor topics. But the solution to these two questions is in the solution in the solutions document on Blackboard, but I won't test you on them for the exam because we didn't get to it. But we got to the biggest and most important stuff, which is the things that we've just covered. All right. So when you're studying, you can study up to example 7. So the balance sheet of Indian River Electronics Corporation as of December 31, 2017 included 12.25% bonds. So this is the stated rate of the bond, stated interest rates, having a face amount of 90 million. So there's the face value, right? That's going to be the bonds payable balance that you will have to eliminate for the carrying value. The bonds had been issued in 2010, so only 7 years have passed, and had a remaining discount of 3 million. So there's your discount on bonds payable balance, right? Remember, the discount on bonds payable is usually a debit balance, but we will now have to eliminate it as part of that first step of journalizing the repayment of the bond. So it had a remaining balance of 3 million at December 31, 2017. On January the 1st, 2018, Indian River Electronics called the bonds. Call the bonds means they're telling the investors they're going to repay the bonds. So they want basically they want the bonds back and they'll give them the money. I mean, there's no real physical exchange of, an actual bond necessarily, but they're paying it out so that the bonds won't exist anymore, right? They call the bonds before this scheduled maturity, right? So it's an early extinguishment of debt, to use the book's terminology, at the call price of 102. So this 102 looks weird over here. Like, what does this mean? It means that they paid 102% of the face value in cash in order to get rid of the debt. I'll repeat, the 102 means that they paid 102% of 90 million in order to get rid of their debt. And let's see what their debt really was. They had a 90 million bonds payable and a 3 million discount. So they owed 87 million, right? That was the carrying amount of the debt, 87 million, but they paid 102% of 90 million. So we can already guess, if we were thinking and paying attention, that there's going to be a loss on this transaction, because you have a face value of a bond of 90, you deduct 3 million discount, so the carrying value of the bond is 87, but you paid over 90 million to settle it, so there's probably some type of loss. The requirement: prepare the journal entry to record the redemption of the bonds at January the 1st, 2018. All right, so take your picture or take down your notes or whatever you need to do before I help all of us to answer this question. All right, so here goes exercise 7 in my final 5 minutes that I have. All right. I may need a little bit more space, so I'm going to just stagger the debits and credits a little bit more. So step 1 was removing the carrying value of the bonds, right, from, and I'll just write it here. So step 1, remove the carrying value of the bonds. And the way you do that is you debit bonds payable and you credit discount, right? That's what's going to happen here. So I'm going to do bonds payable first. Debit bonds payable. The nice thing about bonds payable that we always know is that bonds payable is recognized. It goes in at face value and it comes out at face value. So this is the decrease in the liability because we're paying off the liability, and bonds payable will always be at face. I know that there's going to be a loss, okay, but I'll leave that for a second, and I'm going to credit discount on bonds payable. And the question told me that the discount balance is 3 million. So I'm taking it straight from the question. That's the step 1, removing of the carrying value. Step 2 is the cash payment, right? So you're going to take the face value times the whatever percentage is paid. In this case, it's the 90 million. I'm not going to write out all those zeros again. Times 102%. Remember, they said they called it at 102. 102 means 102%. Cash is being paid, so you will debit. So you will credit cash, right? So cash, let's see how much the amount comes to. It's 90 times 1.02. Oh, I didn't put equals here, sorry. Okay. So this is the cash that we're paying. You see what I meant? That you're paying over 90 million, right? To settle a debt, the carrying value of the bonds is 87 million because it's the 90 minus the 3 million discount. So there has to be a loss here. And you can do the loss in various ways, right? This is the third step now. Is there a gain or a loss is what you're asking, right? So you can see what's the cash, or let's say what's the carrying value. You can compare that to the cash that was paid, right? We know that the cash paid is this. We know that the carrying value in this case is 87 million because it's the bonds payable less the discount. Remember, the discount is a subtraction. So there's going to be a loss here of 4.8 million. The easier way to do it is to balance the journal entry. You're going to say that on the credit side, you have whatever this comes to, 94.8 million, and on the debit side, you have 90 million. So you still need, right, if you add these two together and you subtract the 90 because the dollar amounts have to be equal, there's a 4.8 million loss. It's the same thing, all right? So this is going to be a loss on, I'm just going to call it redemption. I know they call it early, well, I guess the book is probably going to look for it on Connect. Lots on early extinguishment. And so you can plug the number, or you can ask, is the cash paid more or less than your carrying value? And that's going to tell you whether there's a gain or a loss. Again, remember that a discount decreases the carrying value of the bond. So the 90 million face value minus the 3 million discount gives you an 87 million carrying value at the time of the redemption. And the cash paid is more than that. So it's a loss because we had to pay more than we owe to get rid of the debt. So again, a minute to just process and write down stuff and ask me questions, and then we'll be done. Okay, so that's it for chapter 14. You know, there's a little bit of things still here about the, you know, the fair value option of liabilities. You can read through it. I'm not going to go into it too much. It's basically just saying that a company can elect to carry its liabilities at fair value, but it does result in very weird scenarios, because if the liability fair value decreases, you actually end up with a gain. So that means that if whoever you borrow to, the less and less they are able to pay you back, the more gains you are showing in your financial statements. Interestingly enough, I mean, for those who care, I'm not sure that anybody really does. When I was doing my master's at Baruch, in the last accounting class, in the sequence, I can't remember the name of the class, but it was the final, like, capstone accounting class for the master's program to, you know, for the CPA and all of that. We had to write a paper on any topic that was covered, and my teammates and I ended up writing about reporting liabilities at fair value, because that was around the time, a few years after the financial crisis, and a lot of companies that were, you know, had liabilities out, you know, money that they'd invested in other companies that were going bankrupt. They were just showing big gains in their income statement because of this weird result. So I'll stop talking there, but I, you know, if for interest sake you want to read this, you can, but we didn't cover it in enough depth for me to test you on it. So you stop studying at number 7. And I'll see you on Wednesday to go over, what's going to be on the final and to review with you. All right. So you guys are dismissed. Sorry about the 2 minutes extra I kept you here. And go and have a good day. And if someone still wants to stay on because they have questions for me, you're welcome to stay. And I have everybody's attendance, so don't worry about that.